We have a quorum. I call to order the meeting. The Secretariat informed members before the meeting that we will elect a deputy chairman. The Secretariat informed members before the meeting that one valid nomination was received for the office of deputy chairman. The nominated member is Mr. Ken Lee. He was nominated by myself and seconded by Ms. Maggie Chan. According to Appendix 4 of the House Rules, I consult members if we agree to elect a deputy chairman. All right. I declare Mr. Ken Lee elected as the deputy chairman of the subcommittee. I now invite government officials and representatives from the Insurance Authority to join us. Before we begin the meeting, I'd like to consult members if we need to invite the public to express their views on the 3 pieces of subsidiary legislation. If we do, should we consider inviting the public to submit written views? All right. If we all agree, the Secretariat will put up a notice on the LegCo website to invite members of the public to express their views, and will inform all district councils about the invitation. All right, the administration is seated. I'll now invite the government representatives to brief us on the 3 subsidiary legislations. The government officials and the relevant representatives who are present are set out on the agenda. Members who would like to speak, please press the request to speak button. Yes, administration. Good morning, members and chairman. In May 2026, the administration published in the Gazette the 3 subsidiary legislations made by the IA, that is number 57, number 58, and number 59 of the LN. LN 57 and LN 58 are to implement the proposed measures made by the IA, and for LN 59, it is to impose the requirements under Pillar 3 about disclosure of the RBC regime. Since the implementation on the 1st of July 2024 of the RBC regime, we've asked the relevant parties to provide the regulatory returns, and the IA is of the view that the industry can meet the requirements. In relation to the arrangement concerning liability matching as well as risk management, the measures have been effective. To enhance competitiveness of the industry, the IA has conducted a review starting from last year, and one of the focus of the review is to review the requirements concerning infrastructure investment. This is to ensure the long-term development of Hong Kong. We've taken this opportunity to update the requirements concerning general business under Insurance Valuation and Capital Amendment Rules 2026. Through LNs 57 and 58, we will impose the amendments starting from the 31st of December this year. Also, we will implement Pillar 3 disclosure under the RBC regime. This will help the public better understand the risk profiles of various insurance so that they can make an informed decision. This is also to enhance the upkeeping of records to enhance transparency. Through implementing LN 59, we will impose the requirements, and the requirements have been published in the Gazette. For insurers that have to make the disclosure, they have to provide the disclosure returns as well as the audited financial returns starting from the 31st of August this year. That's all from our report. We have the representatives from the IA here today. We welcome questions from members. Now I'll open the floor for questions. A total of 8 members have asked to speak. I'll read out the lineup. Mr. Rock Chen, Mr. Ronick Chan, Mr. Rock Chan, Mr. Holden Chow, Mr. Yu Ming, Ms. Maggie Chen, Ms. Carmen Khan, Mr. Dennis Leung, and Mr. Robert Lee. I'll give each member 4 minutes, including questions and answers. Mr. Ronick Chan, please. Thank you, Chairman. the insurance authority are going to provide preferential treatment for insurers that hold infrastructure investments in the mainland and Hong Kong. As for those that hold Hong Kong dollar infrastructure investment, they will also get a reduction. The government is developing the Northern Metropolis. Will you incorporate Hong Kong dollar denominated bonds into the preferential treatment arrangement? This is to incentivize more companies to invest in the debt as well as equity concerning the Northern Metropolis project. Now I'd like to ask about disclosure. It is said here that insurers will have to provide Chinese and English version of their disclosure statements, and that would incur extra manpower and resources. Will the government consider asking insurers to only provide statements that concern the language of their targeted market? The other question is also about disclosure. Some small and medium-sized companies have been complying with the requirements. I know that you are going to put in place a transitional arrangement for them. Well, they have relatively few resources. Will you provide support to these SMEs so that they can, as soon as possible, comply with the disclosure requirements? Thank you. Thank you, Chairman. I will address the first and third questions. As for the second question, I'll ask the IA to supplement. On the question about the Northern Metropolis, we believe that there will be a lot of infrastructure investments concerning the Northern Metropolis project. So we're allowing a certain level of flexibility. The IA can publish in the Gazette if necessary, so that those that invest in the Northern Metropolis can also get the preferential treatment. The IA will make the relevant arrangements based on the actual circumstances. On the disclosure requirements to be imposed on SMEs, I'd like to give you some background information. The disclosure requirement is an important element of Pillar 3 under the RBC regime. Over the years, we've been in talks with the industry, and they are very clear about the relevant requirement. In 2024, we implemented the RBC regime, but we deferred the disclosure arrangement. That is because we understand that for insurers to comply with the requirements, they will need resources and time to make preparation. Therefore, we deferred the Pillar 3 arrangement to the present. And that's why we have this subsidiary legislation. Over the past 1 or 2 years or so, the IA has been in talks with the industry. Insurers, regardless of their sizes, have been submitting the relevant information to the insurance authority, so they are complying with the requirement. We believe that insurers will have enough resources, therefore, to comply with the requirement. Now, in relation to the question about disclosure statement, I will ask the IA to supplement. Thank you, Chairman. We are asking insurers to disclose information to the public. In Hong Kong, we stick to Chinese and English. Some members of the public prefer the Chinese version, but the original version may be in English. As Mr. Chan said, there will be compliance costs incurred for the insurers. Controllers of insurers will have to sign the statements. So the controllers can sign on the version that targets the targeted audience. As for the translated version, it is only for members of the public to have a better understanding of the information. Mr. Rock Chan. Thank you, Chairman. The proposed amendment is to require insurers to disclose information, including their financial situation. This is a good thing. However, I'm concerned that members of the public may not go through all these documents and statements on their own, then they may not understand the information themselves. This information will be published on the website of the IA. Apart from that, will you prepare a toolkit or an information kit for the public? For the banking industry, for special derivatives or relevant tools, the practitioners will have to explain the information concerning the risks to the public so that the public do not have to go through the documents themselves. That's my first question. Will you learn from the relevant practice? Second question, for infrastructure investments, will you consider building a list on a continuous basis? That is, for those who are qualified, they will be put on the list so that insurers, when they make investments, they could refer to the list as a reference. Administration. On the question about disclosure, we will provide a template for insurers. The purpose is that we want insurers to disclose the information in the form of the same template so that members of the public can make a comparison of the different insurers. As for the point about information kits for the public, we understand that information to be disclosed by insurers may not be easily comprehensible by the public. So currently on the IA website, there is some form of explanation and information that helps members of the public understand the data. Starting from August this year, insurers will start disclosing the information, and we believe that the IA will help the public understand the information to be disclosed. About whether there will be a list of infrastructure investments to help insurers make investments, we have considered this. There are many issuers as well as infrastructure investments. It may not be feasible for us to compile a list and keep updating it. We notice that around the world, there are economies that provide such preferential treatment, and they provide such treatment on a case-by-case basis. So at this stage, we will not provide a list in this regard, but the IA will act as a gatekeeper. As for the approval time, will there be a KPI? Otherwise, if the approval time is too long, there might be implications. I'll ask the IA to supplement. We have proposed a general direction through the subsidiary legislations. That is, there are certain restrictions to the industries concerning infrastructure investments. There are some overarching principles incorporated in the subsidiary legislations. After the subsidiary legislations are passed, we will provide a guideline to define what fall under the scope. We will not have an approval mechanism, but for those that fail to comply with the requirements, we may consider having to approve them.
Next, Mr. Holden Chow. Thank you, Chairman. A couple of questions. First, the public disclosure requirement, which is a new requirement. There will have to be further public disclosures in greater detail about the financial position. I welcome that. My question is for the general public. When it comes to insurance companies, people want to find out about the claim processing, how the payout will work, what losses are not covered. Those are the topics of greater interest to the public. So I wonder, for public disclosure, whether we can cover such information of interest to the public in the disclosure requirement. Now, on the underlying assets, I support the inclusion of Hong Kong-based bonds and infrastructure-related investments. The paper refers to the inclusion of stable coins, and then there will be a read across or read through approach, and then there will also be crypto assets along with the look through approach. What do we mean by the look through approach? Are we saying we focus on the assets underlying the cryptocurrencies instead of the cryptos themselves? I just want to find out how we should look at it. First, about the level of payout, that question can go to the insurance authority. Now, on crypto assets and stable coins, before the law is enacted, we treat crypto assets as intangible assets, meaning we do not factor in crypto assets. We do not factor in the value. But after the law is enacted, we will take a look-through approach. We look at the currencies, the assets behind the stable coins to calculate the value, and then we calculate the amount of risk amount involved. On crypto assets, we recognize the economic value of crypto assets, but we apply a 100% downward stress factor, meaning we treat crypto assets as the least reliable asset. We want to reflect the high volatility, the risk level, and the uncertainty in its intrinsic value of crypto assets. This practice is also found in other places, such as in Europe. It looks like an onerous regime for general crypto assets. Let's look at Hong Kong's insurers. They hold a very tiny fraction of crypto assets. That means this change will have a very limited impact on them. We want to set out a clear framework with this legislative framework so that when insurers hold more such assets, we tell them how to calculate the holdings. Now, on the other question, the IA can give us an answer. On public disclosure, we follow international standards. Now, under Article 20 of the Insurance Association, there's a minimum of information that insurers have to disclose, meaning insurers have to disclose their financial position, their risk level, and how they can manage the risks. On the payout level, the information may have some indirect bearing because the ratio of their capital level and their asset level can also tell us in an indirect way the ability of an insurer to pay out. On the frequency of payout and the operational things, those are not within the scope of the disclosure. Indeed, this is just about the financial disclosure. Next, Mr. Yu Ming. I believe the public will welcome access to greater information from insurers if they will learn more about the financial position of insurers. I believe the public will welcome all this. I want to find out about the information to be disclosed. First, the format of disclosure. What are the differences of our disclosure regime with the practice elsewhere? And what will be the impact of this disclosure requirement on the insurance industry? I understand the insurance industry has maintained the highest levels of integrity. The insurers will have to provide information on request electronically or physically as fast as they can. But what do we mean by as fast as they can? Some may think 2 weeks is good enough. Others may see a month as good enough. So do we have a rule on ensuring timely access to such information for the public. We want to give the public access to the information. So in the insurance documents, can we put in a statement saying that the public can request the information so that the public can have easier access to more information? Now, on the changes to the rules, for eligible infrastructure projects, there will be concessions or preferential capital requirements for insurers. So in the next 3 to 5 years, do we have a forecast? Do we have a goal on the increase in the infrastructure in Hong Kong or GBA infrastructure assets? If the response is not as good as we think, can we expand the scope of the preferential treatment? So can we expand the scope to cover Belt and Road project? Thank you. Ms. Sharon Cole. On public disclosure, there are two parts to our proposal. First, the audited financial statement. Second, the use of the template specified by the insurance authority in making the disclosures. The information to be disclosed includes the company profile, governance structure, financial position, liability, asset and liability statement, etc. When the public requests information, what do we mean by as soon as possible? The legislation does not specify a hard and fast deadline. Our requirement is to provide the information within the reasonable time frame. We have no idea the amount of information requested by the public. Setting a hard and fast rule may not be the most appropriate way forward. So the requirement is simply that the insurer will have to provide the relevant information within a reasonable time upon receiving the request. Now, on infrastructure project, this is the first time that we will allow insurers to invest in infrastructure projects in return for preferential capital treatment. This is an incentive. We're not setting a target mandating investments in this regard. The insurance authority conducted an industry survey. Now, for Hong Kong insurers, investments in local infrastructure projects are at a very low level, below 10%. With this measure here, we will be able to encourage more insurers to invest in infrastructure projects in Hong Kong and the Chinese mainland. We are confident about future growth as a result of the change. We do not have a rigid indicator for the growth target. We will keep an eye on the development. We will review the situation. If we see possible changes that can lead to greater investments by insurers, we will consider those changes and we will closely watch the situation. Thank you, Chairman. Next, Ms. Maggie Chan. Mr. Yu Ming asked about how soon the information will have to be made available. I will accept a reasonable time. When the insurance authority communicates the information to insurers, they should make it clear that the information has to be provided soon, on top of within a reasonable time, because what is reasonable may not be swift for insurers. Now, on the preferential capital treatment for investments in eligible projects, we don't have a list of infrastructure projects for insurers to follow. My question is, can we also include pension funds and also cross-boundary elderly care and wellness industries? An aging population is found not just in Hong Kong but also in the mainland. Elderly care and wellness as an industry is developing in both Hong Kong and the mainland. Can we include investments in elderly care and wellness industries so that the insurance funds can support not just infrastructure but also the elderly care industry? Ms. Sharon Cole. on the point about making the information available within reasonable time, and soon we can tell the insurance authority about that. Now, on the other question, the IA will give us the answer. On infrastructure, we now take an industry-based approach. For certain kinds of public utilities, they will be counted as infrastructure projects. One example is social welfare and public utilities. In our guidelines, we can look at projects that are meant to benefit the public. We can set out the elaborate requirements in the future. I suggest including elderly care and wellness industries. Now, we may not be able to include these small individual players, but for larger projects, we can consider those options. Any follow-up? No. Ms. Carmen Khan. I have some questions, and maybe I will even ask some questions in the second round. I'm looking at LN 58, public disclosure. For insurers of all sizes, we have considered the cost for them and the compliance for them, so we have deferred the requirement. Now, there's a pro forma online. In the Annex D to the consultation document, I see the pro forma that's more than a dozen pages long. Members want to see information that is accessible to the public. Insurance companies also have to familiarize themselves with the pro forma. This new rule will take effect. It was gazetted on May the 22nd. We need a timeline setting out when insurers have to disclose what. Different scenarios may happen. Now, for insurers that were in operation on a certain date, they have to make the disclosures by a certain date. And in other cases, if they don't get 8 months, they get 6 months to disclose their finances because they are no longer in the grace period. We have to give insurers and also the public a clear picture on when they can expect the disclosures. Paragraph 11 says that there will be explanation depending on the situation, so I hope this can be addressed. At the Panel on Financial Affairs meeting in April, we discussed a point that when we implement the risk-based capital regime, we wanted preferential capital treatment not just for the long-term insurers but also for the general business insurance companies. But the government said these general business insurers will have to make a pledge about long-term holding of such projects. What do we mean by the long-term holding? I welcome the acceptance of our suggestion. That should be helpful for their general business. In the 2024 report of Swiss Re, Hong Kong ranks second globally for business density, but the per capita holding remains on the low side. More development for general business and giving more preferential capital treatment for the general business of general insurers will make us more competitive. Those are my two questions.
Ms. Ko, on the timing of the disclosure, it's a little bit complicated. This is because the timing may vary depending on the end date of the financial year for the individual insurers, and the time frame for submitting the information could range from 6 months to 8 months for different insurers. I'll ask the relevant party to put up the information online so that the insurers have a better understanding. Currently, on the IA website, there is simple explanation on the terms that are commonly used by the industry. However, this may not be enough for the public. I will talk to the IA so that we will provide more such information kits for members of the public. The second question is about what it means by long-term holding. I'll ask the IA to elaborate. I thank Ms. Carmen Khan for the questions. At the panel on financial affairs, we said that only those that hold long-term investment will get the preferential treatment. This is because liabilities are longer for those that hold long-term investment, and they will be able to comply with the capital arrangement. We have listened to members' views and we've made some revisions. We will allow for general insurance businesses to enjoy the preferential treatment as well. At the end of the day, we would like insurers that hold such investments for long-term purposes and meet the liability requirements to hold such investments. In the guidelines, we will detail how many years the insurers will have to hold the investments for. Chairman, on the timing of disclosure, I hope there could be a timeline for different scenarios to be provided. Next, Mr. Dennis Leung. I noticed that on the 1st of June 2018, our country rolled out a disclosure management requirement for the insurance sector. We are now scrutinizing a new subsidiary legislation. There are two parts of information to be disclosed by insurers. First, audited financial statements, and second, disclosure statements that cover 7 parts. According to our country's guidelines, insurers will have to provide information in relation to their insurance products, their business operations, as well as other important information in relation to their transactions. When the administration talks to the industry, what kind of information you proposed to be included in their disclosure, but they rejected? And for the information to be disclosed under the subsidiary legislation, is that enough for the public to make an informed decision? Also, I know that insurers stick to MODI as well as SP. There are also other indexes they stick to. With all these ranking information as well as information to be disclosed by insurers, how can the government educate the public about how to read the information so that they can pick the insurance products that are suitable for them? I thank the member for the questions. Concerning disclosure, we stick to the international standard. There is a core standard. And that requires insurers to provide the minimum information required. There are 2 parts of information insurers have to provide. The first part covers information to be disclosed to the IA, and the second, information to be disclosed to the public. We want insurers to strike a balance because we do not want them to disclose trade secrets. For the minimum information required of the international standard, There is certain information insurers will have to provide, and in general, the industry support that. Other than the statutory information that needs to be disclosed, there is other type of information concerning the sales and marketing. Of course, there are rules that insurers will have to comply with when disclosing the information, and that has to do with, for example, the clarity of the information and whether there is any misleading part of the information. What about public education? As said, on the IA's website, there is explanation on some commonly used terms. In the future, we will step up public education. Next, Mr. Robert Lee. Thank you, Chairman. I have some suggestions and questions. Some members just now asked about infrastructure investments. The nature of this kind of investment is that the long-term return is rather low compared with investment in debt and equity. And the US dollar is of a low exchange rate compared with Hong Kong dollars and RMB. We want the administration to come up with more incentives so that insurers can invest in infrastructure projects. This is just a suggestion, no need to reply. I have two questions. The first about crypto assets. There was some discussions about crypto assets. A 100% reduced stress factors will be applied to certain assets. Can the reduced factors be at 95% or a lower percentage even? We see development in virtual assets and Web3. Any kind of reduced stress factors could be an incentive for the industry. Have you thought about lowering the percentage? Second question about countercyclical adjustment. For the cap as well as the floor for the countercyclical adjustment, will you make a change to the percentage? I understand that you'd want to keep the percentage at 10 in order to cope with any volatility of the market. My understanding is that you will allow for a certain level of freedom in the subsidiary legislation so that you do not have to amend the subsidiary legislations from time to time. I want to know if you will put in place a mechanism in case you want to change the cap and floor for the countercyclical adjustment. How can you ensure that the industry has enough information about the cap and floor so that they can make an informed decision? Ms. Koh, I thank the member for the suggestion on infrastructure investment. Where necessary, we will further incentivize local insurers to invest in infrastructure projects. On crypto assets, the member asked if we thought about applying a 93 or 95% instead of 100% reduced stress factor. We have taken into consideration various scenarios, and we've also drawn reference from the practices of jurisdictions around the world. Taking into consideration the risks of crypto assets, we think that it's appropriate for us to apply a 100% reduced stress factor. We'll keep in view the situation. If there is room for us to make an adjustment, we may adjust the percentage of the reduced stress factor. Lastly, about countercyclical adjustments. We will make a Gazette notice if we're to change the cap and floor for the countercyclical adjustment based on the market situation. But before we revise the cap and floor, we will consult the sector. We will not impose a sudden change of the cap and floor. So please rest assured, we will make sure that we communicate fully with the sector. Let's see if the IA has anything to add. We are revising the cap and floor for the countercyclical adjustment, and we propose this revision based on our observation on the equity market. So there are justifications behind our proposed adjustments. As the member said, there is from time to time volatility in the equity market, and internally we will see if the cap and floor is appropriate, and we may revise the cap and floor by making a Gazette notice, and there will be enough data justifying our decision. Ms. Christine Fong. We're discussing the insurance public disclosure rules, which are made under Cap 41. As mentioned by some members, the public may not be able to understand the information to be disclosed by insurers. If possible, we want some form of information kits so that members of the public can make an informed decision of their investment. In Singapore, the MAS ensures a certain level of transparency. For example, information including policy, bonus, product description are included in the information disclosed. According to the IA, the financial statements will have to be submitted within 6 months' time for public inspection. I welcome this idea. Will there be other statements to be provided by the insurers so that members of the public can have a better understanding of the company profiles? My second question is about infrastructure investments. I see that for water utilities, waste management utilities, energy utilities, or transportation utilities are included as part of the industries or infrastructure assets. For waste management utilities, I can think of IPARC 2. For energy utilities, I can think of power supply facilities. For transportation utilities, there's currently a tender exercise for a railway project. For non-listed equities, you will provide a 30% discount. For large-scale government infrastructure projects, how come there cannot be a greater discount?
多謝主席。
Ms. Sharon Cole. On infrastructure, the insurance authority can give us a detailed response. On the first question, public disclosure, many members have expressed this concern. That is, the information will come in a huge volume, and it will be hard for the public to make sense of the information. We can take away this point and discuss the matter with the IA to help the public make sense of the information. The disclosure pro forma offers uniformity for the public to make apple-to-apple comparisons. I understand there's a huge volume of information. It's hard for the general public to make sense of the information. So we can take this point away and find a way to help the public find the information they need when they do see the disclosure. Now over to the IA to tell us about investments in infrastructure and the basis for calculation. Thank you. On the preferential capital treatment for investing in infrastructure projects, some conditions have to be met. First, the industries. The broad direction is set out in the legislation for waste management, energy, power supply, utilities. Those are broadly in line with our industry-based requirements. On the preferential treatment, at the minimum, there will be 0.7. We arrived at that basis after referring to investments elsewhere. For general debt and equity, the risks are lower. How low we go is based on our reference to other infrastructure projects elsewhere. We arrived at 0.7 because we have examined the concessions offered by other economies, and 0.7 is roughly comparable to what's available elsewhere. Now, on disclosure of insurance policies, local residents have told me, say for chronic diseases and cancer in a policy, when the cancer metastasizes or spreads, that goes beyond the coverage of the policy. So accuracy and clarity are needed for insurance policies. This goes beyond the scope of the disclosure mentioned here. We're talking about financial disclosures. On the other points of concern raised by Ms. Fong, on the annual disclosure of information, that will be dealt with under the annual disclosure. On what diseases are covered, the insurance industry group has also just standardized the definition for the diseases covered. Mr. Lau Ka-keung. So this proposal is about public disclosure and the risk-based capital regime. I welcome the change. I have some points to make. I hope the government can consider. So there will be more requirements when it comes to public disclosure for insurance. Small and medium insurers are constrained by resources. We don't want this good change to put the smaller players at a disadvantage. So as we step up requirements about disclosure, I would like to see more support for small and medium insurers. We should come up with guidance for them to follow the rules to reduce their compliance burden. The government also said they would study the matter about disclosing data. I hope the government can also consider these points. The quantifiable data found in the annual RBC disclosure reports, can we come up with a mechanism? On the website of the IA, can we release the industry data instead of requiring individual insurers to disclose the data on their own website? On the quantifiable data disclosure, can we also include such data in the RBC disclosure reports so that the data will be treated just like the quantifiable data? We extract the data from the RBC report, and then we put the information on the IA's website. This will be in line with global practice that will also reduce the administrative cost of insurers. Ms. Sharon Cole. I will take the first question, and then the second question will go to the insurance authority. On small and medium insurers, we have touched on this. The risk-based capital regime was launched in July 2024. For insurers to meet the new rules, we saw pressure on them. That's why we deferred this requirement of public disclosure to this year. We wanted to give insurers a transitional period to get used to disclosure practices. Over the past year, the IA remained in touch with the industry. There were also administrative measures to require the insurers to disclose data or information in the way we wanted, so insurers are clear on what they have to disclose. To give insurers of all sizes an idea of the statutory requirements, the IA will issue guidelines to help insurers comply with the regulations. If insurers have questions, they are welcome to approach the IA, and the IA will be happy to address those questions. On the statistical data and the quantifiable data, those questions can be addressed by the IA. We inserted a provision in the legislation for the RBC regime about the public inspection of insurance data. In that public register, financial data were added. We ask insurers to release the information or disclose the information on their own website, and then the information will also be released on the IA's website. So it's the same set of data. The public disclosure is a responsibility, a statutory responsibility for insurers. So the data is also released by the IA. We added an amendment for the RBC legislation about the public register. So the nature of business and the place of business were to be disclosed. We also added a requirement. So in the public register, people can also see the financial data of insurers. So one thing we have in mind is the information to be publicly disclosed by insurers. Next, Mr. Andrew Fan. I support the direction of the public disclosure requirement. When it comes to risk management, the information has to be timely and reliable. Insurers will have to disclose the financial statements within 6 months, so that ensures reliability, but timeliness is a problem. Information that is 6 months late may mean that the insurer involved may have simply fled. In that time frame, we have artificial intelligence and blockchain. Can we do more to give the public timely access to the information? The information may not be as reliable as audited statements, but timely access to data may show that an insurer is in trouble. So people will have access to the information in time, and then they can be careful. Can we also have mechanisms for regular monitoring of insurers? So can we plug in the systems to give the IA access to the information right away? And as long as it's in line with the rules, can we also make the information publicly available? Ms. Cole. The member suggested a shorter interval for timely disclosure of information. That is good news for consumers. But that will also create pressure on insurers because that will lead to higher costs for insurers. We have to strike a balance between the right to know for the public and also the cost implications for insurers. If an insurer runs into trouble within a year, what do? We're talking about submitting financial statements and disclosing the statements. On top of this, the IA also monitors insurers in other ways. The monitoring will ensure that once insurers run into trouble, we will be able to spot it right away. Now, the IA can tell us more. Thank you. The public disclosure will have to be made 6 months after the statement. But then there is also a disclosure requirement about submitting information to the IA within 4 months. Now we give the insurers 2 more months, so the financial statements that are audited will have to be made public in 6 months. The situation can change. Under the insurance authority or insurance ordinance, the IA has the power to supervise insurers. One supervisory measure is to look at the governance structure and the risk level of the investment and whether the risks are mitigated in time. Every quarter, we receive the financial returns of insurers. We review the situation to see if insurers meet the statutory requirements. I understand what the Secretary says. There is cost, but the cost is minimal for insurers. There are different figures on different ratios. The insurers know how much in assets they have, how much they're investing. They do not look at their risk management every few months. There's no way for them to say they have no idea about their own position. No one can say they have no idea whether the stocks they have are in trouble. That information should be readily available. The insurers will only take 5 to 10 minutes to give you the daily position of their data. I'm not asking for the information right away. I'm saying you have to manage the risks in time. My question is, should the data be made public only after auditing? Can insurers disclose unaudited data on their own? The IA can take the questions. Insurers already have to disclose the same data every 4 months. The same data will be made public later. The information to be disclosed publicly will be extracted. That encompasses the key data that is already submitted to the insurance authority. I understand Mr. Fan's point. The financial data is available quickly. The financial data to be made public will be in line with what is submitted every 4 months. We will also require insurers to add footnotes to the financial data, and that will mean more time is needed to make sure the insurers can meet this new requirement. We give insurers an extra 2 months' time.
Ms. Carmen Khan speaking for the second round. Thank you, Chairman. On disclosure, I have one more point to make. Apart from providing an information kit to the public, you may learn from the SFC's website. There's a short video on the website, and that could help investors learn more about the insurers. Sometimes investors only look at some figures, but they do not know how to calculate the insolvency ratio. We want investors to know how to look at the various data so that they can make an informed choice. That's about disclosure. Now going back to paragraphs 13 to 14 of the paper. It explains why we need to put in place such a mechanism to enhance Hong Kong's competitiveness, and it talks about the northern metropolis. I'm happy that the administration took on board our suggestions. Of course, we'll also have to see if the insurers will be able to comply with IA's guidelines. Can you give us examples of the practices in, for example, the UK and Singapore? What kind of reforms have they put in place to enhance the competitiveness of their insurance sectors? This is to explain at the policy level why we need to put in place such a mechanism. Paragraph 14. Well, the borrowing ceiling is increased to $900 billion for the government. If the GIB requirement is met, then additional capital preferential treatment could be provided to the insurers. A lot of times these government bonds are oversubscribed. Will you earmark a certain number of bonds for insurers? If not, how will the insurers be able to meet the requirement in terms of their investments? There was more background information provided to us at the panel on financial affairs. We'd like more information about eligible infrastructure investments in assets. Will you prefer insurers making investments in the mainland bonds or Hong Kong government bonds? And how will the public be able to identify what kind of bonds insurers invest in? This has to do with the level of risks faced by the public as well. Also, you want to incentivize insurers to invest in long-term infrastructure projects in Hong Kong. So you're going to provide preferential treatment to listed insurers. Can you tell us a little bit more about this, Ms. Koh? I thank the member for the questions. On disclosure, I thank the member for the suggestion. We'll see how we can step up public education. Now, on the point about infrastructure investments. When we designed the RBC regime, we drew reference from practices around the world, and that includes the practices of the International Association of Insurance Supervisors, as well as the framework adopted by, for example, the Basel Bank. They apply a 2 to 3% rate for the preferential treatment, and the practice we propose are in line with the practices around the world, so we believe we'll be able to enhance our competitiveness through this framework. For mainland and infrastructure and Hong Kong infrastructure projects, if insurers invest in these projects, they'll get a preferential capital treatment. We want to encourage insurers to invest in infrastructure projects in the mainland and Hong Kong. We hope to directly benefit the infrastructure development in these two places. We only allow for insurers in Hong Kong and the mainland to get this treatment. We want to better channel investments capital to infrastructure projects in the mainland and Hong Kong. We've made reference to practices in other places. In the mainland, there is a similar arrangement. If you invest in infrastructure projects there, you will get a similar preferential treatment. I'll ask the IA to supplement. I thank Ms. Carmen Khan for the questions. For item A, we're going to apply a 70% reduction. And we propose this reduction based on the capital requirement we impose currently. So for bonds issued by the government as well as those issued by Hong Kong, the preferential treatment would be different. For item B, we ask insurers that get the treatment to be listed in Hong Kong. That means insurers listed on the Hong Kong Stock Exchange. We'll provide a guideline in terms of what it means by being listed in Hong Kong. As to how we define an instrument issued in Hong Kong, we will look at whether the relevant project is initiated in Hong Kong. We'll provide a guideline on that. Yes, Ms. Khan. I thank the IA and the administration for the explanation. I'd like to ask further questions on infrastructure investments. How can you ensure that insurers do not only get government bonds? Take private equity funds as an example. They may invest in the Northern Metropolis project in other ways. If I am a private equity fund, how can I meet the relevant requirement? Also, how can you ensure that insurers do not only invest in Tier 2 projects or those that are relatively more mature? Take waste management utilities as an example. It is an established project initiated by the government. We want to direct insurers to invest in, for example, projects in the green field. How can we ensure that insurers can invest their long-term capital in projects in the green field? For example, will they get a further reduction in capital requirements if they invest in these projects? Can we provide more guidelines for insurers so that they know what kind of investments are considered eligible? IA? We will detail what kind of industries will be included in infrastructure investment in our guideline. Under the RBC regime, we already allow for insurers to get a preferential treatment if they make general debt or equity investments. And we will apply in future a look-through approach to see if insurers can comply with our requirements concerning their infrastructure investments. Well, you said you will come up with a guideline for infrastructure investments. Apart from looking at the investment period, well, if insurers make a change in their investments, say I made an investment in equity and then I switched to debt or bond investments, will that still be counted as part of a long-term investment? Well, please detail that in your guideline. Are there any other questions from members? If not, we will proceed to the clause-by-clause scrutiny of the 3 pieces of subsidiary legislations. I suggest that we look at the Chinese version, and the legal advisor will look at the English version. Please note that the legal advisor of this subcommittee on the 27th of May made inquiries with the administration on the Insurance Valuation and Capital Amendment Rules 2026 and the Insurance Public Disclosure Rules. The administration on the 27th of May provided a written reply to the questions. The reply is included in LS 23/2026. It's in the annex of that paper. Now I will first ask the administration to brief us on the provisions of the Insurance Maintenance of Assets in Hong Kong Amendment Rules 2026. Please refer to Parts 1 and 2 of LN 57 as well as the marked up copy. That's LC paper number CB bracket 1627/2026 bracket 01. Legal advisor, please remind members of the points to note as well as any drafting or legal issues. Members who have questions, please press the request to speak button. I'll ask the administration to explain the provisions now. Let's look at LN 57 first. Please refer to the marked up copy prepared by the LSD, and please also look at CB bracket 1627/2026 bracket 01. LN 58 seeks to amend Cap 41R, the Insurance Valuation and Capital Amendment Rules 2026, and we are amending the name of the counterparty risks. Please refer to page 1 of the marked up copy, pages 1 to 3. The amendment will start to take effect on the 31st of December 2026. It also sets out the commencement date, and Provision 2 says that Cap 41T will be set out in Clause 3. Please look at page 3. It repeals 45A and the relevant wording, and that's a consequential amendment. That's all for the clause-by-clause scrutiny of LN 57. Do members have any other questions? If not, we have completed the scrutiny of this part. Now let's move on to the next item. Now we look at LN 58. Please refer to CB bracket 1627/2026 bracket 02. This is to amend Cap 41R, the Insurance Maintenance of Assets in Hong Kong Amendment Rules 2026. Now I will talk about the various parts. First part, interpretation. It sets out the commencement date, that's the 31st of December 2026. Part 2 states that in Part 2 and 3, the way of amendment will be set out. Part 2, it is to amend the preferential treatment to be enjoyed by insurers. That's clauses 3 to 6. Please refer to pages 1 to 3 of the marked up copy. The purpose is to add 44A, and the new section 44A is to add terms such as eligible infrastructure investment. It defines what it means by eligible infrastructure investment. The place where the insurer is listed, the designated industries, as well as the qualitative criteria are all set out here.
I have a question. Section 44A(1)(c). Hold the investment for long-term purposes. We were talking about the issuance of guidelines. That's not defined here, correct? I'm talking about to hold the investment for long-term purposes. So that will be elaborated on by way of guidelines. So how many years they have to hold the asset, equity to debt, etc. Those will be in the guidelines of the IA. Mr. Robert Lee. Thank you, Chairman. I want to follow up on holding the investment for long-term purposes. My question is about the definition. We heard that there will be a guideline with a detailed requirements. Sometimes a long-term investment may be 10 years or 30 years. An insurer may have planned their investments. They want to hold the investment for the long term, but then due to various situations, they may have to sell some investments to recoup the investment. On the face of it, they may look like they are speculating for the short term, but they may offer a reasonable explanation. What do we do about the situation so that they also meet this long-term requirement? Different scenarios may occur. They may buy an asset and then they sell the investment tomorrow. Do we have enough flexibility to accommodate such circumstances? Chairman, the IA can take this question. Thank you. Again, this will be dealt with in the guidelines. Our goal is for insurers to hold on to long-term infrastructure investment. That is our policy direction. On how long they have to hold the asset, that will be set out in the guidelines. An insurer may sell the assets before the target. We will look at whether that happens all the time. If insurers fail to meet the holding target, we will find out with the insurer whether they're trying to hold on to the asset for the long time or they're selling for a profit. That should be something the insurer can explain. Of course, we don't want abuse. If the insurer speculates in the short term all the time, of course, we don't allow that. But I wonder, we should build in enough flexibility, so we should allow reasonable explanation. So we will talk to the industry to clarify the matter. Mr. Holden Chow, thank you. We were talking about holding the investment for long term. I will leave that matter. I have some questions about D and E. D is about the 6 requirements for infrastructure project. So revenue that is reasonably predictable. The project should be able to meet the obligations under stress, and the major risks are properly managed. These requirements are properly set out. But then E is about the corporate. The corporate holds the infrastructure project. there's a distinction between the project and the corporate. Let's say I'm a corp. I have many projects. Some of them are major infrastructure projects, but the same corporate may also hold other non-infrastructure projects. My reading of E is that the requirement is looser. Revenues are reasonably predictable and the corporate is of good credit quality, and then there is secured funding. So that's good enough for the corporate. My point is, there are 6 criteria for infrastructure projects. Those are rigorous requirements. But for the corporate, in comparison, the corporate is subject to looser requirements. The holdings of insurers matter. Why do we apply what appears to be looser requirements to corporate? So can the officials explain this to us? How can a corporate meet all the requirements? A corporate may hold projects that are not infrastructure. So what do we make of it if that happens? Thank you. So there's a distinction between investing in infrastructure projects and also the corporates holding the project. The IA will take the question. Thank you. The 6 criteria under D refer to the infrastructure project themselves. For eligible infrastructure project, the corporates holding the project will have to generate most of their revenue from the infrastructure project. Under E, the requirements appear to be looser. We're talking about specifically for A2, the revenues have to be reasonably predictable. That means the corporates will still have to meet the other 5 requirements. So the authorities will consider the situation and decide whether something meets the requirement. Whether the corporate meets the mark, you will look at whether they generate most of the revenue from infrastructure projects. But there is no hard and fast rule, so it's not like they have to have 60 to 70% of their projects being infrastructure. So there is flexibility. Is that the point? They will have to generate more than half of the revenue from infrastructure. For listed companies, say CLP and Hong Kong Electric, they generate most of their revenue from power generation. So that would be an example. Ms. Carmen Khan. We're at clause-by-clause explanation. Section 44A is important. When inserting this clause, we have to be clear on what we mean by eligible infrastructure investment. I hope that since we are going through the provision, the government can explain the definition in detail. Can we go through this item clause by clause? Bracket 1, bracket 3 is not subsidiary legislation. This means Electrical will not have oversight over this clause. There will simply be a Gazette notice. The government will simply specify what is an infrastructure project. So can the government tell us which of these provisions will not be subsidiary legislation? And can the government also take us through what do we mean by infrastructure investment and what we mean by infrastructure corporate? On the long-term purposes, it says to the satisfaction of the IA. Do we have a definition on what we mean by to the satisfaction of the IA, or is there simply discretion? Is this discretion anywhere specified or defined in the legislation? Now, the definitions for eligible infrastructure investment and infrastructure corporate, this is defined under 44A. For infrastructure, it's the physical structures supporting essential public services that bring economic and social benefits. On infrastructure corporate, this means an entity or a corporate group that derives the substantial majority of its revenue from owning, financing, developing, or operating infrastructure assets. Sorry, I'm looking for examples instead of someone just reading out the definition. I can read for myself. What do we mean by substantial majority? What do we mean by generating a substantial part of the revenue? I need examples. The IA gave us examples. CLP, Hong Kong Electric. Those two are in the power generation business. They generate most of the revenue from power generation. If they have a new project, say they want to build a new power station, and if a future insurer invests in such a project by holding a bond or an equity right, that investment will be an infrastructure investment. Or we can take it in the northern metropolis. Let's say we're building highways, or we're building a waste recycling or management facility, or we're building waterworks. If these projects involve debt equity or bonds, insurers can invest in such products, and then the downward pressure stress factor will apply. And then insurers will be subject to a lower requirement for capital. This will be an incentive for insurers to invest more of their funds into such infrastructure projects in the northern metropolis or even in the mainland or other infrastructure projects in Hong Kong. Chairman. For insurers to benefit from the preferential capital treatment, they will have to consult the IA. They take an interest in a project and then they ask, is this project eligible? Would this happen? Does the IA anticipate such questions? Does the IA have the resources for all these questions to come from the industry? Chairman, you're from the insurance sector. My question is this definition self-explanatory to your industry, or will there be guidelines on this? My concern is that some provisions are not subsidiary legislation. There will be no more legislative oversight. We want clarity for the industry. So this is for the IA. Will there be guidelines for infrastructure projects? Have we talked about this with the industry in the earlier consultation? The definitions in the legislation set out the broad direction. Ms. Khan's point is that people wonder what project counts. We will set out these points in detail in our guidelines, and then we will also consult the industry on the guidelines. Now, if the project insurers have in mind are broadly in line with the guidelines, then we will not need the case-by-case approval. When will the guidelines take effect? The subsidiary legislation will take effect on the 31st of December this year. When will the guidelines come out? Will the guidelines come out before December? The legislation will take effect on the 31st of December. We're in June now. If we can finish the scrutiny, then we will compile the guidelines and consult the industry on the guidelines between July and December so that we can have the guidelines ready, meaning we have 6 months' time to have the guidelines ready. So can the government also point out which of the provisions are not subsidiary legislation? Under 41R, we propose allowing the IA to issue Gazette notices. So for infrastructure investments, under the new Section 44A 1A3, that provision says the insurance authority can issue an Gazette notice from time to time to specify what is an infrastructure asset. And then 44A 1B, the IA can also issue Gazette notices specifying that a certain industry count as an infrastructure investment. And then we look at Section 48. There's a table for A. The IA may, by way of a Gazette notice, specify how insurers can invest in Hong Kong dollar-denominated government bonds for extra downward stress factors. So that's another example of Gazette notices.
17
37(10) states that the insurance authority will publish in the Gazette the list of insurers carrying on offshore insurance businesses. Where are these provisions? We did not specify which part will not be regarded as subsidiary legislations. However, we adopt the same wording in Cap 41R, the Insurance Valuation and Capital Amendment Rules 2026. There are parts that state that the IA can publish a Gazette notice. Is it that there won't be a distinction between central projects, or are they all regarded as Chinese mainland projects? In the provision, we state that it's the Chinese mainland, but we did not specify whether it's central government projects or local government projects. However, we ask insurers to put in place measures to mitigate risks. Considering all the information to be provided, we will decide whether the project invested is an eligible infrastructure investment. Ms. Maggie Chan, I'd like to ask about 44A(1)(c). I want to know the legal effect of bracket C in this part. Is my understanding correct? 44A(3) states that an applicable insurer must hold the investment for long-term purposes. If my understanding is correct, I think the Chinese version does not align with the English version. I don't see that the phrase "to hold investment for long-term purposes" is included in 44A(1)(a). Would you consider reversing the order of bracket 1B and bracket 1C? Would you consider adding the word "and" after bracket 1A Roman numeral 3 so that the point about insurer having to hold investment for long-term purposes also apply to bracket 1A without the word "and"? Bracket C would look like an isolated item. I thank Ms. Maggie Chan for the questions. There are A to F under 44A. After numeral number 3, there's a semicolon, and we consulted the DOJ, and we're advised that this is appropriate. What it means by eligible infrastructure investment, insurers will have to comply with conditions A to F. So Will C become an isolated item? No. This is because insurers will have to comply with A, B, and F as well. And it is only by complying with all these requirements that it would be considered as an eligible infrastructure investment. It's a detailed explanation, but it fails to convince me that without the word and, bracket C would also apply to bracket A, Roman numeral 3. For the general public, they may not understand it this way. If you tell me that brackets A and C have to be fulfilled together, then there should be the word and before bracket C. Otherwise, it would look like an isolated item. We will consult DOJ further on how we can better draft this in order to avoid any misleading content for insurers and the general public. I think this is very crucial. It says the authority will publish in the Gazette the requirement. I'm worried that there might be disputes if this is not made clear enough. Thank you, Chairman. Can you consult the DOJ and give us a reply? Thank you. Mr. Holden Chow. Thank you, Chairman. I'd like to ask about 2A and B. It talks about infrastructure corporate and infrastructure project. It says an infrastructure corporate means an entity that derives a substantial majority of its revenue from owning, financing, developing, or operating infrastructure assets. My question is this. Ms. Carmen Khan actually asked a similar question. An entity that derives a substantial majority of its revenue from owning or operating infrastructure assets, but we do not know whether it is a central government project or a local enterprise project. From a macro perspective, people may want to know what kind of projects an insurer invests in. It says here, bracket 2A or bracket B. If it is listed in Hong Kong, but the project is not carried out here but elsewhere, such as the mainland, would that be considered as an infrastructure project here as well? Would it be possible that debts are issued here and that other projects are carried out here as well, but it is not clearly understood? I just want to know the logic behind when you draft this part. I thank Mr. Holden Chow for the questions. Bracket A or bracket B means either or. So it has to be physically located in Hong Kong or the mainland. If it is not, then it may also get the preferential capital treatment if the location of issuance or listing of the investment is in Hong Kong. So if you meet the definition above about timing and quality, and you also meet one of the conditions here, then you will get the preferential capital treatment. The infrastructure project may not be located in Hong Kong or the mainland, but as long as the investment is issued or is listed in Hong Kong, then the requirement is met. Ms. Carmen Khan? Chairman, riding on what Mr. Holden Chow said, I think bracket 2A here means the formula that you apply or the reduced stress factor would be different. At the panel on financial affairs, we looked at the PowerPoint presentation prepared, so we have a better idea about this. So please provide a table stating the difference between A and B. And actually, the table gave us a better idea of the distinctions between A and B. Well, I'm rather concerned about the quality criteria set out here. What factors did you take into consideration when you came up with this criteria? It says the relevant asset has to be secured, and that good credit quality of the infrastructure corporate has to be ensured. I want to know how you came up with these criteria. I don't want these criteria to be too stringent. If it's hard for insurers to meet the requirements, that would not serve the purpose. Our original aim is to encourage more insurers to invest in infrastructure projects so that the economy of the mainland and Hong Kong could benefit. So I want to know if these 6 factors are competitive enough. Please refer to 44A, bracket D and bracket E. As Ms. Carmen Khan said, for infrastructure investments, 6 criteria have to be met. Currently, an insurer that invests in infrastructure investment does not get preferential capital requirement. The reason why we amend this is because we want insurers to invest more in infrastructure projects as long as these projects are in Hong Kong or are listed in Hong Kong. Compared to other economies, we provide a better preferential capital requirement or treatment. As to how stringent these factors are, I'll ask the IA to supplement. The principle is to mitigate the risk because this is a risk-based capital regime. Whether it is debt or equity invested, the IA will have to ensure that the infrastructure investment made are not high-risk investments. I'll ask the IA to elaborate.
開咪俾保監嚇。
Can we switch on the microphone for the IA's officials? We propose the concessions on the basis that without such preferential treatment under the current risk-based capital regime, the capital requirements apply, and those requirements are on the high side. Now we propose a stress factor like 0.7. As long as those debt and options meet certain criteria that will reduce the risk level. On whether we are being excessively onerous or lenient with the 6 criteria, we have referred to global practices. Criteria such as reasonably predictable revenue and mitigated risks lead to lower risks. With secured revenue, that means steady income. That will be a necessary requirement for an investment to qualify. Now, for qualified insurers, are we also including insurers that have redomiciled to Hong Kong? This proposal covers both general business insurers and long-term business insurers. So first of all, this new arrangement will cover all insurers when an insurer is redomiciled to Hong Kong and they invest in Hong Kong. We still need some more clarity on issuance under 2B. Will there be guidelines on issuance? There will be guidelines on that. Mr. Robert Lee. Investing in infrastructure, mostly in Hong Kong and the mainland, I understand there is no hard and fast rule, 80%, 90%, 98%. So will this be dealt with under the guidelines? How do we make sure there is an objective standard without arbitrary standards? We're talking about a broad spectrum. How do we minimize disputes? How do we ensure there's dialogue between the regulator and the industry so that we have both flexibility without arbitrariness? Singapore and Europe define a majority as at least 75%. The IA will spell out the details in their guidelines on what we mean by the substantial majority. There will be dialogue, and that will clarify on what is meant by the majority. To keep the RBC regime competitive, the IA will talk to the industry and then amend the guidelines in a timely way. No other questions? We move on. Now, Clause 4. Members can refer to marked up copy, pages 4 and 5. LN 58, Clause 4. 48R, lowering the reduction factor for eligible infrastructure investment under the credit spread risk. 4.1, 4.2, and 4.3 make textual and consequential amendments to 48 under 48. Section 4.4, there is a new paragraph CA and CB. CA and CB insert the new table 4A. This is about the reduction factor under the credit spread risk. Under 4A, categories A and B are defined. Ms. Carmen Khan asked a question about this. Category A has to do with the location. meaning physically in Hong Kong or in the mainland. The place of issuance or listing has to be in Hong Kong. Table 4A states that for category A, the reduction factor will be 0.7 minus 0.1 multiplied by a parameter. The IA will publish a Gazette notice to specify the parameter. Category B, for an eligible infrastructure in Hong Kong, the reduction factor will be 0.8. Paragraph CB, if an instrument meets the requirements as a green bond and an eligible infrastructure project, only one reduction will apply, meaning both deductions won't apply at the same time. Ms. Carmen Khan. Where is category A and B defined? That's my first question. My next question has to do with the factor 0.7 minus 0.1 multiplied by the parameter. This has to do with the credit spread risk. Can we have an example? How would this work? So category A 70%, category B 80%, but there's a variable under category A. Thank you. The member can refer to pages 6 and 7 of the marked up copy. Paragraph, or rather page 6, on the bottom right corner, on the bottom right, there is table 4A. You see the reduction factor and parameter. Page 7 sets out what category A and B mean. We have to look at 44A. That provision defines what is category A. Simply put, category A means an eligible infrastructure investment, the substantial majority of which is in Hong Kong or in the mainland. Category B, again, this refers to section 44A to B. The location of issuance or listing has to be Hong Kong. To give you an example, let's say hydropower in Hong Kong. As long as it meets the criteria under 44A, the insurer will be able to apply the stress factor. So because this project meets the requirement, the factor is 0.7. Now, before this new legislation, the insurer will have to hold $100 in risk capital. With the new rule, they have to hold $70 instead. The $30 freed up can be invested elsewhere, so that will lead to greater efficiency and flexibility for the insurer. On the 0.1 multiplied times parameter, with that, we're trying to encourage insurers to invest in Hong Kong dollar denominated bonds. The infrastructure projects will be published in the Gazette. The more infrastructure projects insurers hold, they will benefit more. Let's say much of the money of that insurer is in Hong Kong infrastructure projects. That insurer will get an extra 0.1. Now they will get a 0.6 factor instead of 0.7, so they will have more money freed up for other investments. Thank you. This explanation is helpful. Now, based on the legal advisor's paper, Table 4A will be in a Gazette notice. We will not get to scrutinize and discuss the table, so they will consider the relevant factors to arrive at the parameter. To encourage more GIBs in the NM, we can be more aggressive with the parameter so that insurers will know how to make their choices. Should we spell out that this Gazette notice is published from time to time. I'm looking at page 3, item F. It says Gazette notices published by the IA from time to time. But elsewhere, other references to the notice does not say from time to time. So will we add the language from time to time so that people won't take the paragraph CB to mean CA and CB to mean you issue the notice once? The phrase from A to A is found under 44(1)(f). The IA can specify other criteria in Gazette notices from time to time. This applies only to the criteria. This is because A to E set out the basic criteria. Insurers can refer to A to E, and also the subsequent guidelines to be issued by the IA for the eligible infrastructure investments. For categories A and B and the parameter, these elements are not referenced elsewhere. To give effect to these new rules, the IA will spell out these points through a Gazette notice. Without the IA specifying the parameter, nobody will know what the parameter is. That's why we omitted the phrase from time to time. But if there are other criteria already in the legislation, we add the wording from time to time so that this is something the IA can supplement and add after a review in the future. Can you revisit this point? Under 44(a)(1)(a)(3), the Gazette notices will spell out what the infrastructure assets are. I believe those notices will be issued on multiple occasions. 44(2)(a), those are about the industries. The industries may change over time. So a notice may be issued from time to time to spell out the industries. I'm also looking at page 1. Again, the notice won't be subject to legal scrutiny. If you don't say the notice is issued from time to time, does that mean the notice is issued only once? So can you give yourself this flexibility, Mr. Van? Thank you. We will review the matter to see if change is needed to the wording. Mr. Holdenchild. We're at 4. These are the more technical formula. The industry will know what it means. Outsiders cannot really make heads or tails of it. Now we have the formula for the parameter. The infrastructure may be in Hong Kong or in the mainland. The mainland infrastructure can be a project of the central authorities or local authorities. In any case, they follow the parameter. So the parameter will not fluctuate from project to project. From my reading of the text, as long as a project meets the criteria, they will stick to this parameter. Can I confirm this is correct? We may consult the public in writing on this subsidiary legislation. The formula is only accessible to industry insiders. Can we get the industry to tell us? I understand we have gone through the industry consultation, but through the written submissions, can we also get a sense of the industry's ideas? Have we looked at the practice elsewhere? I don't quite get the formula right there. We need input from the industry insiders. I know we have gone through the industry consultation, but since we're going through the written submissions anyway, can we get the industry to just comment on the formula? I extend the meeting by 15 minutes.
Any response to what Mr. Holden Chow said? Mr. Chow's understanding is correct. If the conditions under 44A are met, including the quality criteria and other criteria, then the parameter of 0.7 will apply. If the IA is to publish a Gazette notice on further parameters, it will be about insurers that hold certain government bonds. As for the feedback from the industry, we will provide a reply on the consultation outcomes. Now we come to Clause 5 of LN 58. Please refer to pages 8 to 12 of the marked up copy. The purpose is to amend Cap 41, Section 19, and it sets out the risk capital amount for equity risk. 5(1), page 8 of the marked up copy, we're adding 49(1)(a) to 1C. It sets out the calculation methods of risk capital amount for equity risk. That includes 49(b)(1)(a) and B. Insurers can make use of the correlation matrix for diversifying risks. Ms. Carmen Khan. Maybe we will touch on the difference between listed and non-listed projects as well as the reduced stress factor. Yes. On equity, we will come to that part when we get to 5A. That is how the reduced factor will apply. 5(2) are textual amendments to Section 49. Please refer to pages 11 and 12. Table 5 sees an addition of Section (2)A. It spells out how many downward stress factors can be applied for eligible infrastructure investments. Columns 1 and 3 refer to categories A and B. As for column 2 and 3, we see listed equity and unlisted equity. For category A, the reduced factor is 0.8 minus 0.1 times a parameter. As said, the IA will publish a Gazette notice specifying that insurers that hold government infrastructure bonds will get a further 0.1 reduction. Say an infrastructure investment is held in the form of an equity. After the reduction applies, the insurer, instead of holding $100, only need to hold $80. If the insurer holds more government infrastructure bonds, perhaps $70 will only need to be held by the insurer. If it is a unlisted equity, then a further reduced stress factor will apply. That's 0.7. If it is an infrastructure bond and it is an unlisted equity, then the insurer that invests in this will only need to hold $60 instead of $100. That means $40 of capital can be released for other types of investment. As for category B, be it listed or unlisted equity, since the location of issuance is in Hong Kong, we recommend a 0.85 stress factor. That's about a 15% reduction. Our policy is to encourage insurers to invest in infrastructure projects in the mainland and Hong Kong. Yes, Ms. Carmen Khan? I'd like the administration to explain this. That's bracket 2A on page 11. It talks about portfolio investment of look-through and no look-through. Can you give us some examples to illustrate this? Here it also talks about the reduction factor for listed and unlisted equities. For unlisted equities, the reduction factor is greater. As said by Mr. Fan from the FSTB, for unlisted equity, the reduction factor is greater. And what are the considerations behind? Thank you. I will ask the IA to explain this. Ms. Khan mentioned Table 5. The 50% stress factor for portfolio investment of no look-through do not fall under the proposed legislative amendment, but I'll ask the IA to explain anyway. For an infrastructure project that can be isolated, then you may refer to the formula under 5A. For private equity funds or other funds, it depends on whether a look-through approach is applied. If a look-through approach is applied, then Table 5 can be used. For some companies, a look-through approach may not apply. In that case, we'll have to refer to bracket 2A for the downward stress factor. I understand what it means by no look-through under bracket 2A. But how come a greater reduction factor will apply for investment in unlisted equity? For category B, the reduction factor for listed equity is lower than that for unlisted equity. This is because we apply a reduction approach. For ordinary investments, be it listed equity or unlisted equity, for listed equity, the risks are lower, so the factor is lower than that for unlisted equity. For unlisted equity, the insurer will have to meet the quality criteria and other conditions. We are of the view that the income generated for investing in listed and unlisted equities are more or less the same. So in order to align the two, the reduction factor for unlisted equity is greater. I don't quite get it. I'm not sure if other members understand this. Well, could you provide an example? Well, let me explain in figures. For listed equity, I may have to hold $100 of capital, and with reduction factor, I only need to hold $70. For unlisted equity, the capital requirement may be $120 instead of $100. If it is $120, as I said, there will be a reduction factor. The reduction factor for unlisted equity has to be greater in order for the levels to be aligned for both listed and unlisted equities. Well, now I get it. For unlisted equity, the denominator is different. So that's why you allow those investments to apply a 0.6 reduction factor. Next, Ms. Christine Fong. Thank you, Chairman. I'm looking at 4A and also Table 5A. The insurance authority provided a PowerPoint presentation which gives a much clearer explanation. You have categories A and B here, and columns 1, 2, and 3. Column 2 refers to listed equity, and column 3 refers to unlisted equity. This is not clear enough. Can you provide a table that applies to subsidiary legislation 41R? We will consider this option. There are tables in the latter part of this subsidiary legislations. There are also textual illustrations. For tables or contents that are not in the form of table, we will review them. Dr. Johnny Ng, according to the insurance authority for unlisted equity, the reduction factor is greater. That's why there is the difference in terms of capital requirement of $120 versus $100. Does that mean the government would like to encourage greater investment in unlisted equity? You mentioned the anticipated returns and income. For listed equities, the investment would incur a lower risk for insurers. This is because it's easier for insurers to sell these listed equities. And how come at the policy level you encourage insurers to invest in unlisted equity? I thank the member for the questions. Under the risk-based capital regime, as you said, investment in listed equities, the risks are lower because of higher liquidity, and that's why the parameter is lower. For unlisted equity, the liquidity is lower, and that's why the parameter is also lower. We apply reduction factor, and we realize that for infrastructure investment in equity, be it listed equity or unlisted equity, there will be anticipated or guaranteed return. And so the risks for investing in listed or unlisted equities are not high, or the risks do not differ greatly. And that's why we apply the 0.6 factor for unlisted equity and 0.7 for listed equity. This is not our policy direction. Instead, we talked to the industry and we realized that a lot of investments are made in infrastructure projects. For low-risk investments, for example, investments in unlisted equity, we want to mitigate the risk, and that's why we apply a lower reduction factor. Should we extend this meeting by another 15 minutes so that we can deal with more provisions? I have a suggestion. Members have asked a number of questions concerning, for example, the tables. I see that members are concerned about the actual implementation of the regime. Well, there is still a big part that we need to go through. Well, I suggest that we extend the meeting by another 15 minutes so that we can deal with more provisions. Well, what I mean is that if it's possible, we could save this until the next meeting. Well, this is just a suggestion.
我哋用咗15分。
Let's go for another 15 minutes up to 16 for completeness sake. Clause 6, members can refer to the marked up copy, page 15. Under 41R, Schedule 7, we insert a new table, which is Table 3C. This is for calculating the eligible equity investment. So this is the correlation matrix for prescribed capital amount and risk capital amount. Page 15, there's a table. We have columns 1, 2, 3. For an insurer holding eligible infrastructure investments, the percentage will be 100%, no reduction. If an insurer holds eligible infrastructure investments to some extent but not in full, they get 75%. So the 75% reflects the benefit of such assets in percentage terms. Part 3. Now we will add part 2 about the infrastructure. Part 3 has to do with general business. Clauses 7 to 14 are about this part. Clause 7, members can refer to the marked up copy, page 16. This is for the non-Hong Kong member of a Hong Kong insurer or a specified insurer to exclude their general offshore reinsurance business. 7.1, page 16. Consequential textual changes to the text adding subsection 6. We will see that under 7.2. Clause 7.2 from pages 18 to 22 on the marked up copy. A few new provisions are added, 37, 6, and 12. The new provisions include an approval mechanism so that a non-Hong Kong insurer of a Hong Kong insurer, once it sets up a separate fund for their offshore reinsurance fund with the approval of the IA and meeting certain criteria, can exclude a certain amount from their prescribed capital amount. Simply put, if they have this offshore reinsurance business and this insurer is a Hong Kong branch of a non-Hong Kong insurer, this Hong Kong branch will also qualify for the preferential capital treatment. We want to encourage such branches to engage in offshore reinsurance business. Clause 8. Mr. Holden Chow. Thank you, Chairman. I want to find out about Clause 7. Based on our understanding, we are providing an extra incentive for non-Hong Kong insurers to come here. We want them to expand their offshore reinsurance business. Based on this discussion, so we're saying we're granting reduction to lower the capital requirements for such non-Hong Kong insurers. Am I reading this right? I want to check my understanding. Ms. Sharon Cole. Mr. Chow is correct. We want this change to allow the Hong Kong branch of non-Hong Kong insurers to enjoy a lower capital requirement, but that capital has to be with the group. That means they have to have the funds to meet the business needs. With this change, the Hong Kong branch will keep less money so that we can attract more such offshore reinsurance business in Hong Kong. I have a question. have we assessed for this incentive to bring in reinsurance businesses? Do we expect a certain how much of an increase in such reinsurance businesses do we expect? I don't need a hard and fast number, just want a rough number. We cannot predict how many extra reinsurers will be here. This exercise adjusts the capital requirement for insurers. Our projection is that with all these changes in place, for general business, the overall capital requirement will go down by 12.8%. So that's roughly $5 billion. For insurers, the burden will be eased, and that will bring more insurers to Hong Kong. Thank you. Ms. Christine Fong. On Clause 6, for general offshore reinsurance funds, there's a reference to item 8, and then under 8 there's A and B. B applies to the insurer, and if applicable, the minimum solvency levels for the applicable insurer. What do we mean by the minimum solvency level? And then for item 7, the second provision, this regime will also require the group to be able to meet an adverse loss seen once in 200 years. By once in 200 years, in the mainland and in Hong Kong, do we have a reference point for, say, natural disasters? Now, for the reductions for offshore reinsurance, this insurer will have to apply to the IA for the reduction. We will impose conditions. The minimum solvency levels, as Ms. Fong mentioned, will mean that the insurer or the group, the current statutory level is 100%. In terms of the capital in reserves, the requirement will be maybe 110%. On the catastrophe risks, the RBC regime also sets out a way to calculate the risk level. Now, we haven't come to that point. We will allow insurers to adopt the basis of a catastrophe that is once in 200 years. So when we say once in 2 centuries, this can be a natural catastrophe. We want greater clarity for insurers. Do we have a standard? Do we have a reference value? Yesterday, some parts of Hong Kong saw 140 millimeters of rainfall. So by the once in 200 years, what criteria are we adopting? Are we talking about the level recorded by the Hong Kong Observatory? The relevant organizations can apply for this reduction to the IA. When will this be included in the guidelines? It's not stated. Now, on the catastrophe risk, there are established and standard factors involving formulae. we're now relaxing the rules to the extent that we allow insurers to adopt their own approach. If they can adopt as a basis catastrophes seen once in 200 years, we can exempt insurers from following our formulae. For the formulae and the risk factors, are we talking about what's in Table 9? Are we talking about the percentage in Table 9, meaning catastrophes seen once in 2 centuries? We take that as a basis for the calculation. Is that the case? If not, can you elaborate? We're talking about different points. For the risk, there's a fixed risk factor. We have to stick to it. We allow insurers to adopt their own internal once in 2 centuries levels. Insurers have their own internal modules or models. They have a better sense of their own risk appetite and the kind of risks they're exposed to. They have their own estimate. We require them to take once in 200 years as the basis. They have to be clear about the assumptions. So that's what this exercise is about. On the proportionate reinsurance and the non-proportionate business. This is about their risk provision. They have to set aside a certain percentage of money. We can lower the percentage requirement. Last one to ask a question, Ms. Carmen Khan. And then we will conclude the meeting after Ms. Khan is done with her question. I have a question about 6. Page 18, bracket 6. I have some follow-up questions. I will follow up on the rest at the next meeting. Sub-rule 6. Are we trying to attract general reinsurance businesses if they underwrite offshore risks? That is discounted, is that right? We're doing that to bring in such reinsurers. So there's this concept of a designated insurer. So what do we mean by designating? What's the policy thinking behind this? By designated insurer, this is defined under the Insurance Ordinance. This means an insurer not incorporated in Hong Kong. But Hong Kong makes up a sizable chunk of their business, and this insurer is subject to the IA's oversight. So we designate such a business as a designated insurer. This insurer is subject to the same rigorous regulations of the IA. The designation is in place. If new insurers expand their business presence in Hong Kong and they hit a certain level, the IA will designate those insurers as designated insurers. Now, for non-Hong Kong insurance groups, if a mainland or external insurance group sets up a branch in Hong Kong and this branch engages in general offshore reinsurance, under the existing rules, their capital has to be factored in under our RBC regime. The non-Hong Kong headquarters, maybe in France, maybe in Canada, are also subject to some sort of RBC regime or prudent regime. The capital is counted more than once. That would be prejudicial to the offshore reinsurance in Hong Kong. So our proposal is that since the headquarters are already subject to the RBC regime, we want to avoid double counting. So that with the amended rules, the Hong Kong branch won't have to hold on to the risk capital. As Ms. Khan said, that will attract such businesses. Since we're doing away with the double counting, there will be more offshore reinsurance business members. At the council meeting on the 24th of June, I will move a motion. At the council meeting, I will extend the scrutiny period to the 15th of July this year. Do we all agree? If so, please also note that there are two timetables. First, reporting the matter to the House Committee on the 3rd of July, and then giving notice for amending the subsidiary legislation. There will be 5 days, so up to the 8th of July at 5 p.m. The Secretariat will let members know the date of the next meeting. And please can I get the administration to provide a response to the matters raised at this meeting in writing. If members wish to move an amendment, please get your draft amendment in by 5 p.m. Wednesday, the 17th of June. So that adjourns the meeting today. Thank you.